This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on support and resistance. I'll first begin by talking about what I mean by support and resistance. I'll make the important point that it's support and resistance that controls price, not news. You need to use the stop that is based upon the time frame that you're watching. For example, if you're trading a monthly chart, use stops based upon the monthly chart. Also, because computers dominate trading, support and resistance is usually precise. Support is a price below the market. It's a price where buyers might be stronger than sellers. In other words, it's a price where selling tends to stop and buying tends to take hold, and you often can rally. The market rallied at this price here. It rallied at this price here. When it gets down to that general area, you have to assume the bulls will buy again, just like they bought here and here. And therefore, traders use the term support to describe this area. And bears keep selling around this price. They sold here, they sold here, they sold here, they sold here. And chances are, when the market gets near this zone again, they'll sell. It doesn't matter what the price is. You don't even have to know why the market might be selling there. All you have to know is every time it gets to this price level, the market has a hard time getting through it. This price level is resisting rallies, therefore it's resistance. Traders call support and resistance inflection points because when the market gets to a support or resistance level, it can either break through it or reverse. The market is making a decision. The term used for those areas where the market is deciding whether to reverse or resume is an inflection point. There's a potential for a big move. The bulls bought a couple times here. They bought a little bit above it here. But look what happened when it came down and tested it this time. It broke strongly below it. Whenever the market approaches some prior level, a support level, you have to be ready for the possibility of either a reversal back up or a strong break below. Here, the market broke strongly below support at the bottom of a trading range. The market sold off, it bounced. When it got near this high, it sold off again. When it got near this high, it sold off again. These prior highs then are resistance. Look what happened here. We got a reversal up. We have another reversal up. I can draw a line. I want to see what the market will do if it gets near that line again. Will it strongly break through it or will it reverse up? Here we started to reverse up, so traders will buy on the reversal up. That line is supporting the market. Why should you spend time looking for support and resistance when the market's in a trend? It's because of my 80% rule. 80% of the time, a strong bear trend will not stop at support. Likewise, a strong bull trend will not stop at resistance. The market has inertia. It tends to do what it has been doing. And that means that if the market's in a strong bear trend, every time you see a possible support level, you have to assume the support will break and the market will continue down. Instead of a lot of buying at the prior low, the market continued down. Instead of buying at that low, the market continued down. The market's trying to reverse a decent looking bull bar. Tried to reverse a second time. Here, a small double bottom, another reversal, another reversal. 80% of reversal attempts in a strong bear trend will fail. And they'll fail at some kind of a resistance level, like the bear trend line. And they'll then become bear flags. So instead of a reversal, this rally becomes a bear flag. The market breaks to the downside and the bear trend resumes. Traders draw trend lines and they look to sell reversals down from the trend line, betting that the trend reversal attempts up will fail and that each bull reversal attempt will become a bear flag and the bear trend will resume. Traders will also sell strong bear trend bars closing below prior lows, betting that the breakout will have follow-through selling. We have a strong bear breakout below this low, and then the next bar is a bear bar as well. So they'll sell that, betting that the bear trend will continue down. They'll bet that the support of the prior low will fail. top of the channel. This channel is a parallel of this line. I could have simply drawn a line across this high and that high. But in any case, the market hit the top of the channel and we have a bear bar. Traders will sell below that bear bar, betting that this reversal attempt will fail and the bear trend will resume. The bear trend line is resistance. Every trend reversal takes place at support and resistance. Whether or not you see the support or resistance, if there's a reversal, there is support or resistance there. If the market's reversing up, it's at some support, a measured move, a trend line. If the market's reversing down, there's some resistance. For example, the top of a bear channel. The market reversed up here, but look at this. This pullback failed to get above that high. This is a very big bear breakout with follow-through. It might be a measuring gap. Traders will pay attention to that, and they'll look at either the midpoint of the gap between this high and that low, or simply this low, and project a measured move down, and then see what the market does when it gets near there. A measured move target is support. Late in a bear trend like this, traders expect some kind of transition into a trading range. They'll look for support levels, and one support level is based upon a measuring gap. 3 pushes down, 1, 2, and then up, and then 3, or 1 and 2, up and 3. Parabolic wedge sell climax at a measured move target. Higher probability of at least a minor reversal into a trading range. A good location to take profits. Aggressive bulls would buy there. If I extended this channel down further, this would also be at the bottom of the channel. Support, always a good location for taking full or partial profits. And aggressive traders will buy, but a very tight bear channel like this, probably a minor reversal into a trading range. Here's a trading range. Now, why should anyone pay attention to support and resistance in a trading range? Again, my 80% rule. When the market's in a strong trend, 80% of reversal attempts will fail. When the market's in a trading range, 80% of breakout attempts into a trend will fail. Breakout attempts will fail at support and resistance. Obvious resistance at the top of the trading range. Obvious support at the bottom of the trading range. You have to expect that a bear breakout will fail. Because they expect breakouts to fail, they look to buy low and they look to sell high. They expect breakouts to fail, so they expect the sell-off to be limited and they expect the rally to be limited. And therefore they take quick profits. They scalp. They buy low, sell high, and scalp. Top of the trading range is resistance, so traders sell. Bears sell to initiate positions. Bulls sell to take profits. If a bull buys down here, he's going to be taking profits somewhere in the middle or top half of the trading range, certainly on a reversal down. If a bear sells here, he's going to be taking profits in the middle or bottom of the trading range, certainly on a reversal up. Bulls will get long at the bottom, reversal up. Bears will get short at the top, reversal down, especially second entry sells. First entry, second entry. First entry, second entry buy. Higher probability if there's a second entry. Markets exist to make trading easy. Institutions created markets because they wanted trading to be easy. If you're a buyer, you need a seller. If you're a seller, you need a buyer. It's much easier to find the opposite side of a trade if everyone agrees to be participating in a market. If there's no market, you have to go door to door to find someone who's going to take the opposite side of your trade. As a corollary, markets always try to maximize the number of trades and the trading volume. Markets are constantly searching for a price where most of the trading will take place. It never knows the exact price. The fair price constantly changes. There are countless variables entering the market at all times, and that means the fair price, the exact fair price, is existing only for a second or so. It's constantly changing. Markets usually have to go too far down to find out how far down is far enough, and they usually have to go up too far to find out how far up is far enough, and then they oscillate in a fair price range. Most of the time, the markets are in some kind of a range, a band of where they think the prices are fair. The bulls feel like it's good enough price to buy. The bears feel like it's good enough price to sell. If you think about it, if the price just kept going down and down and down, at some point the bears would decide, I don't want to sell there, it's too low. If the market kept going up and up and up and up, at some point the bulls will say, I don't know, this is way too expensive, I don't want to buy here, I'll wait for a pullback. And the volume dries up, and the market will have to pull back to find buyers. Support and resistance, it constantly pulls the market. The market is constantly trying to find out if there are more buyers or sellers at support or resistance. Will one side give up? Will there be a breakout or a reversal? Look at this. The bears sell, they sell, they sell, they sell, they sell. This is resistance. You know it because by definition, if the market goes to a certain price and sells off, that's what resistance means. Traders call that resistance. When the market does it repeatedly, it becomes more reliable resistance. The next time the market gets there, traders are more confident that the sellers will return again. Bulls buying in a tight channel, but then we get a big breakout below the trend line. The trend line was support. I could have drawn the line across these lows, but I'll draw it across here. This clearly means the bulls are no longer able to support the market at the trend line. The market has to go lower to find a price where bulls will buy again. The bulls are giving up. A give up bar, a bear breakout below the bottom of the channel. The bulls are selling out of their longs, and bears are selling as well. They see what's going on. They see the break below the trend line. They see a buy climax and a second buy climax, possibly a second leg trap. The biggest bull bar in 15 bars or so, possibly the end of the trend. Second entry short, 1, 2, higher probability for a reversal down. Bulls sell out of longs, bears sell into shorts. All markets are constantly in search of the fair price. It usually has to probe too far up and too far down to find the band of fair prices. And then it probes in the opposite direction. Bulls trying to continue higher, but every time it goes down, up, down, tails on the tops of bars. Maybe the market has to go lower to find buyers. It looks like we're running out of buyers at this price, and it looks like sellers are very eager to sell. This might be the top. Big bear breakout, but not good follow through and a reversal up in an area where bulls bought previously. Not enough traders willing to sell at this price. The market probably has to go higher to find sellers. This, therefore, is a support zone. If you listen to television, you're listening to news reporters. They believe everything takes place because of the news. But most of what they say is caused by the news, has nothing to do with the news. It's just a coincidence. Support and resistance, it's the single most important force behind market movement. Markets are constantly probing support and resistance, trying to find a fair price level or a zone of fair prices. And that's the single most important thing that traders have to learn. It's not the news, it's support and resistance. The market's in search of a fair price zone. When you see this could be a daily chart, 5-minute chart, doesn't matter. The news is going to see the stock market went down. They'll look for some news and they'll say the news caused the stock market to go down. That's nonsense. The stock market went down because it's been probing up and it's unable to go up, and therefore it usually has to go in the opposite direction. It's deciding that this is the top of the range of fair prices and it's looking for the bottom of the range of fair prices. It sold off to an area of a prior low. They bought here, they bought here. We're down to that level again. They bought here and they bought again here. They found buyers at the bottom of the range. What happened to the news? If this was due to news, what happened here? It's not news. It's the market in search of a fair range of prices. Television likes to say news causes moves. It does not. It sometimes can be a catalyst that begins a move, but any move that you see is simply a probe of support and resistance, the market looking for fair price. This is a monthly chart of the dollar versus the yen. Without knowing the news, I'm assuming this is going to go up. We have a bear channel on the monthly chart, and it's getting very tight. The trend line and the trend channel line, it looks like a wedge bottom. 75% chance there's going to be a bull breakout. That means 75% chance soon the news will report some event and claim that it was responsible for this bull breakout. That's nonsense. The market's telling us that it's going down too far, it's running out of sellers at this price, it's going to have to reverse up to find sellers. We know that when the market's in a spike pullback channel, 75% chance you're going to get a bull breakout, and then either a trading range or a bull trend. And during this breakout and this breakout, I'm sure there was news, but the market was going to do that regardless of what the news was. Fundamental factors lead to trends that can last for years. Here's a bear trend that lasted for 5 or 6 years. Here's a bull trend that lasted for 3 or 4 years. Ultimately, the market's controlled by fundamentals, but any given move that you see on the chart, it's a probe for a range of fair price. Especially short-term moves over the course of weeks to months, it's not news, it's fundamentals, the market probing for a fair price, looking for support and resistance. Support and resistance, always important, and it creates a lot of trading opportunities, but you have to know where it is. You have to be looking for it, and you have to be looking for patterns. We have a wedge bear channel, 75% chance we'll get a bull breakout, and the conversion into either a trading range or a bull trend. I'm much more interested in the technical setup. This is telling us that the market is finding support at this area, and it's probably too low, and we're probably going to go up higher. It doesn't matter what the news is. The chart is telling us that the market's going to go up. So is the chart telling us that there's going to be a news event? Who cares? All I know is when I see that, I expect the market to go up. Wedge bear channel, bull breakout, higher or low, major trend reversal, and then strong bull breakout. The bull bar is closing on their highs, the bull bar is getting bigger. We're going higher. This was a support level. The market rallied from there, and we broke below it, reversed up. This pulled back to test that level, so this is an important price. Important price usually leads to a measured move. From this high to that important price, this is a measured move area. It's probably a support level. So now we have a wedge bottom at a measured move target. Higher probability that we'll get at least a bounce. Monthly charts, you need monthly stops. Stops based upon the monthly chart. And the monthly chart of the dollar versus the yen. If you're trading on the monthly chart, use stops based upon the monthly chart. Don't go looking at the daily chart or 5-minute chart for your stops. Here's the 5-minute chart. If you're trading that monthly chart and you happen to look at the 5-minute chart, ignore the moves on the 5-minute chart. Only pay attention to the monthly chart. Very often, a lower time frame chart or a higher time frame chart will be doing the exact opposite of what you're seeing on the chart you're trying to trade. If you're trading on this chart, only pay attention to this chart. Here we have a very strong bull trend and a pullback. We have an II that makes it a high 1 bull flag. And it's the first buy signal in 3 months other than buying closes. This is the 5-minute chart, and this price corresponds exactly to that price. This is the entry for the breakout on the monthly chart above the II. If you're day trading, you look for setups on the 5-minute chart. You cannot wait 3 months for a buy signal on the monthly chart. So if you're trading on the 5-minute chart, ignore the monthly chart. Just trade the 5-minute chart. On the other hand, if you're trading the monthly chart, ignore the 5-minute chart and just place your trades based upon what's going on with the monthly chart. Very often, you'll see a big move, or any kind of a move, or a reversal on a 5-minute chart, and it's caused by support and resistance on other time frames. Since reversals on higher time frames occur much less often, if you're trading the 5-minute chart, in general, it's not worth paying attention to the higher time frame charts. The signals on the higher time frame charts are so infrequent that you'll be wasting your time. There are far more signals that you'll see on the 5-minute chart alone. Again, most of the moves that you see on any chart are due to the support and resistance on the chart in front of you. It may correspond with support and resistance on a higher time frame or a lower time frame chart, but usually there's something on the chart that you see that will tell you that there's support or resistance, and it will tell you how to trade without looking at other charts. So don't worry about other charts. Strong bull breakout bar, very big bull bar closing on its high, closing well above the high of the prior bars. And then the following bar is a bull bar as well. High probability, 60% chance you'll get some kind of a measured move up based upon the size of this breakout. Any resistance, any minor resistance will fail, and you have to find any reason to get long. The breakout is racing up to test resistance. It's decided that the price level is too low, so it's in search of a higher price, and it expects that there'll be at least some profit taking at resistance. Whenever I see a big bull bar like that, and I think the odds are it's going to lead to a trend, I pay attention to the open of the bar and the close of the bar, and then I project up to a measured move. A lot of traders will take profits there. At this point, 60% chance we're going higher. At this point, the stop is below here. 60% chance that if you risk this much, you'll get that much. And that results in profit taking around a measured move up. We tried to get a top here, instead we get another breakout. And this pullback tested this high, potential measuring gap, the bottom of the bull flag, and then the breakout above this attempt at a reversal, also a measured move up. So we have two measured move projections at this price. And you can see what happened. We have profit taking. Those measured move projections create resistance. You can draw a bull trend line, create a parallel along the top, and you can see we're having a bull breakout above a bull channel. 75% chance it'll fail within 5 bars and test down to the bottom of the channel. So other resistance at this price level as well. The market was sideways here. It tried to form a high 2 buy, high 1, high 2, decent looking bull bar, double bottom. It paused, but then we got this big bear bar, and you look at that and say, that shouldn't have happened. That's a surprise. Whenever you get a surprise, you have to assume there'll be at least a small second leg down. When I see a big bar like that, I look at the next bar. Does it have a bull body? No. Increases the probability we're going lower, no bull body. And then we start to reverse here. I look to the left. Is there a gap? This low, this high, there's a gap. This bar might be a measuring gap leading to a measured move down. I'm more confident about selling here. The bulls tried to reverse here, high 1, high 2, but a possible double top lower high, bear flag, a bear body, makes me think it's worth selling below this bear bar for at least a little bit more down. The market's racing down to support. But what support? Where's the support? Well, a good place to start is looking for a measured move from this high to either this low or the middle of this gap. You can see what happened there. This low reversed up, this low reversed up, maybe a bear channel, and you can draw a trend line across the top. So now we have a wedge bottom and a reversal up at the bottom of the channel. We broke below the channel by a little bit. Now we have a bull bar at a measured move target. That is support. Clearly a trading range, lots of reversals. Trading range, so you buy low, you sell high, and you scalp. In general, you should look to sell maybe in the top third, top half, expecting continued resistance and expecting every probe up into that area to fail and lead to a reversal down. That's the sell zone. And in the bottom third, bottom half, you can see every time it gets down to this level, it's reversing up. This is the buy zone. It's support. 80% rule, you have to expect that 80% of breakout attempts will fail, even if the breakout attempts are strong. Support and resistance can be very, very precise. It's calculated by computers. It's especially precise for the E-mini, a huge volume market controlled mostly by computers. The data is very reliable. Everybody sees the same prices, unlike Forex markets, where every broker has a different price, slightly different. The result is in the E-mini, the math is very precise, and targets are often within 1 tick of the actual price. Weak rally, trying to get a double top reversal down at the top of a trading range. Instead, we get a breakout, a close above the high of the past 20 bars, and then an even bigger bar. Very clear for computers. We have a gap this low, these highs, and they're able to calculate very exact support and resistance targets. We have a reversal up, a trend line. That allows us to create a channel. I just keep dragging it to any price that contains all the bars to the left, and then I look to the right and I see what happens. And it reversed down. So it's reversing down at the top of a channel and at a measured move target. Strong breakout, expect at least a second leg up. We got the second leg up, and that's the minimum that the bulls needed. And now they see resistance there as well. So you get profit taking. Very precise. Experienced traders all see the support and resistance targets. Everyone agrees on the targets, and the decisions that everyone is making, they're using the same information. You have to learn to spot the targets. Reversal down, possible start of a trend line. Reversal down, draw a line. And look at this. When I got to the line, it reversed down. Some traders will try to sell with limit orders at the line or a tick below. Others will sell on the reversal down. And bulls who are long will take profits there. Spike, pullback, channel, 3 pushes, 1, 2, 3. Very often a spike in a channel has 3 pushes. Bulls will look to take profits around the top of the channel. We gapped down, tried to sell off. Theoretically, the market wanted to form a double top. It did not. It just kept going up. However, because of a potential double top, you have to be thinking that maybe there's a potential measured move up based upon the height of this sell-off. And look at this. Exactly to the tick. Very precise in the E-mini. E-mini and stocks are both controlled by computers. Traders pay a lot of attention to entering and exiting based upon math, where the projections are, where the support and resistance is. If a trader is good at spotting support and resistance, he knows where to take profits and he knows where to enter trades. I began by talking about what I mean by support and resistance. I made the important point that support and resistance controls price, not news. If you're trading on a monthly chart, use stops based upon the monthly chart, not based upon a smaller time frame. Computers dominate the biggest markets, and therefore the support and resistance is extremely precise, especially in a market like the E-mini. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on support and resistance. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on support and resistance. I'll begin by talking about what support and resistance is best. Well, the answer is it depends on context. Any support and resistance can be best depending on the current situation. Forex support and resistance is not as precise as support and resistance in the E-mini and many stock markets because there is no central exchange where all the trades are reported. Every broker, every bank has its own price, so traders with one broker are seeing charts that are slightly different from traders with another broker. As a result, support and resistance is not as precise. I'll then move on and give examples of support and resistance. Moving average, that's a reflection of the average price. That is often support or resistance. Here we're in a bull trend, and you can see the market is finding support anytime it gets near or below the moving average. Trend lines, here we have a very tight bull channel. When the market broke below it, the bulls came back. The top of channels, reversal down, draw a line for a potential top of a channel and see what the market does. It broke out and then it reversed. So resistance at the top of a channel. Prior highs and lows, the market got to this high, sold off. Got to this high, sold off. A low here, it got there just a little bit below, rallied. Got a little bit below, rallied. Here, it got to that prior high and broke out and then pulled back and it became support. Measured move, we have a leg up in a trading range. Odds were it would be followed by a leg down, Instead, we get a breakout. So you're going to be thinking about a potential measured move up based upon the height of that leg in the trading range. Big round numbers, 2100, and then a smaller round number, 2090, 2080, 2070. You can see the market raced up to the big round number, tried to break above it, pulled back, tried to break above it a second time, tested it, bounced again. Which one's the most important? Well, any type of support and resistance can be the most important one on the chart. It depends on the context, and it depends upon the strength of the support and resistance. Forex support and resistance is not as precise for many reasons. I'll talk about some of them now. 5-minute chart of the euro versus the dollar. Every broker has its own data. Many Forex trades are taking place simultaneously at different locations all over the world, and nobody reports the trades to any one central location, so the prices are not the same everywhere. The chart that you get is not the same as the chart someone else gets if they have a different broker. Because the major institutions are aware of the differences among the different Forex brokers and Forex banks, they are able to arbitrage and keep the prices close to one another. If one price is a little high, they'll sell at the broker or the bank that's high and buy at the bank or broker that's low, keeping prices close to one another, but not identical. 3 pushes up, 1, 2, 3. We have a wedge top. Measured move. A high 2 attempt with a good buy signal bar. Instead, we get a big breakout. And you have to assume the market's going to get at least a little bit more down. Here it got a lot more down. And we have a pullback, testing the breakout point, maybe a measured move in between the 2 points, maybe a measured move simply from this point. We have a bear flag, maybe a double top bear flag. It tried to break to the downside, but then it reversed to the upside. Pulled back below the breakout point, continued up, pulled back again to the breakout point, and continued up. So we have support here. Maybe it'll lead to a measured move up. It did. The space between this low and that high became a measuring gap. The market went a little bit above it, tried to resume up 2 more times, failed, and then went the other direction. Resistance. Because of the arbitrage activity among the institutions, the prices among the different brokers usually are fairly close to one another. Usually they're within a pip or 2, but they're rarely ever identical. Look at this low. It's 1.1419, but it might be 1.1422 at another broker or 1.8 at other brokers. There's no centralized market. No one tells other brokers where the last trade was, and therefore the last trade is irrelevant. And it can never be known because there's no central place where everyone reports trades. Every bank conducts its own trades and doesn't report to anyone. You could have hundreds of banks having trades taking place simultaneously, all at slightly different prices. So there's no last trade. And the result is the last trade on one chart might be one price, and a chart from another broker would be another price. For example, look at this close. It might be 1.1384 at one broker, and 8.3 at another broker, or 8.7 at a different broker. Furthermore, it can change instantaneously within a fraction of a second at all of the different brokers. This is an example comparing Interactive Brokers and TradeStation. TradeStation no longer provides Forex trading, and Interactive Brokers has greatly restricted their Forex trading. Interactive Brokers created this chart based upon the trades its clients are placing. TradeStation created this chart based upon the trades its clients are trading. Anybody can look at both charts and look for discrepancies. Because of that, institutions are able to keep the prices similar. If they see that one broker has prices that are too low, institutions will buy it, bringing it back in line with everybody else. The data remains similar, but not identical. Also, the default chart for Interactive Brokers is the midpoint between the bid and the ask. And for TradeStation, it's the bid only. The chart ignores the ask. and therefore that also accounts for differences between the charts and the prices. You can see over here for Interactive Brokers, look at that high. And then here's the same time for TradeStation, and this is 1 pip lower than the price for Interactive Brokers. I want to give some examples now of support and resistance. This is the euro versus the dollar, and there are 200 ticks per bar on this chart. Because Forex support and resistance is less precise than, for example, the E-mini, traders are less concerned about exact prices, and they're less concerned about the types of charts. For example, tick charts here, or charts based upon time, like a 5-minute chart. Not everyone uses 5-minute charts. This chart has 200 ticks per bar, and the patterns are clear. It doesn't matter what type of chart you use. You could use time charts using any amount of time per bar, 1 minute, 15 minutes, 60 minutes. You can use tick charts that have any number of ticks per bar, 50 ticks, 219 ticks, 1,000 ticks. You can use other types of charts as well. It doesn't matter. They're all representations of what the market is doing, and the patterns are going to be similar on all charts. A 5-minute chart of the euro versus the dollar. You can see some measured moves, not precise, but close enough for traders to pay attention to the support and resistance. At some point, computers will totally dominate Forex trading, just like they do the E-mini and most major stock markets. Also, funds are increasing their participation, and over time, the math will become more important and support and resistance will be more precise. Now, it's very good, but I believe over time, it'll become extremely precise. Reversals, as soon as traders see a reversal down, they begin to look for another reversal down so they can draw a line. They could draw a line here, but once it goes above it, they have another reversal down, they'll draw the line here. Reversal down here, reversal down here. See what the market does when it gets to the line. Broke above it, traders could then draw another line using that high. The channel began as fairly tight. However, once we've had this breakout, it now is fairly broad. You could draw another channel with that low and this low. In any case, Forex channels, the prices are constantly going beyond lines, more so than with other markets because of the imprecision of Forex pricing. As the trend progresses, traders like to redraw lines and they're looking for best fits. So for example, traders might say, well, maybe at this point here, they'll look back and say, what's a best fit line? Maybe using near that high, maybe this high, and then looking to see what happens when the market gets near that best fit line. You're trying to find some line that the market appears to be respecting. Turning down here, turning down here, turning down here. At some point you decide, if I use lines based upon highs, the market never gets there, yet it seems to be turning down in the general area of a line here. So traders will use an approximate line and see what the market does when it gets near it. You want to capture the overall trend and not worry that the lines are rarely precise with Forex markets. If a line is not obvious, it's not important, computers will not be using it and it will not provide much support or resistance. Can you sell this reversal down? Well, you might be at the bottom of a tight trading range and it might not go far. However, we have a breakout bar closing on its low, a big bear bar closing near its low. At this point, the odds are high that we're going at least a little bit lower. Higher probability of profit if you sell a breakout with strong follow-through, a sell the close market here, expecting at least a little bit more down. Bears will also sell reversals down from the trend line. They have a good-looking bear bar closing on its low, reversing down from a best fit trend line. They'll sell on the stop just below the low of that bar, and they'll get filled right here. If they sell here, where's their stop? Possibly above the high of this bear bar, or they can put it above the most recent lower high up here. Both are acceptable. If you have two reasonable choices for a stop, you can use either one. If you use a tighter stop, you'll lose more often, but you'll lose less money. If you use a wider stop here or here, you'll lose less often. When you do lose, your losses will be bigger. But if all the stop choices are reasonable and you take 100 trades, your profit will be about the same no matter which one you take. The goal is to just use a reasonable stop. In a bull trend, traders are looking to buy a reversal up. The market reversed up here, it reversed up here. You can draw a line. And then see what the market does when it gets near the line. You can see it undershot the line, did not get to the line. Tried to get down to it again, tried to get down to it again, and it keeps reversing up. You have to assume it's not going to get to the line, and it's probably worth buying above the high of the prior bar. A second entry buy, first entry above this bar, second entry above this bar. 3 different attempts to get down here, it could not. You always have to be looking for other lines. We have a reversal down here and a big reversal down here. That might be an important line. And if so, it's always worth creating a parallel and dragging it to some point in between that contains all of the prices. So you pick this bar because if you draw the parallel line at this low, all of the prices between the two tops will be above the line. And then after that second top, you see if the computers are paying attention to this line. And clearly they are, here and again here. So the markets are using a parallel line, or at least a lot of computers are. If one line's not working and another line is, you get rid of the line that's not working. And you should be buying reversals up. We have reversal up and a second entry buy here. You could buy above this small doji bar or above this bull bar here. You could buy above this bar, or you can take a second entry here. This is a double bottom, and these two tails, a micro double bottom. The market's rallying from near the bottom of the bull channel. If you buy here, you have a micro double bottom, reasonable to put a stop here. However, it's also reasonable to put a stop below here. This is a major higher low. It's a low that had a reversal up to a new high, and the reversal up was strong. Again, if you use the tighter stop, you lose less, but you lose more often. And if you use the wider stop, you lose more when you do lose, but you lose less often. Both are reasonable, and therefore using either one is okay. Using a stop that's way too far down or way too tight, you're going to lose money. So if you buy here and put a stop 2 pips below, you're going to lose money. If you buy here and put a stop 2 pips below, you're going to lose money. Most patterns do not look perfect. They do not look like textbook patterns. But if they look reasonably good, they're good enough, and the lines will create support and resistance. Wedges, for example, they're rarely ever perfect. But if the context is good, traders will look for reversals at the lines. We reverse down, you can create a line. We reverse down again, traders will sell. Reverse down, create a line, and look what happens when the market gets near that line. Same here, reverse down, watch to see what happens when the market gets near that line. When you see it reversing, you look to sell. Same again here, reversal, and then see what happens up here. Now, I have this wedge 1, 2, 3, and you say, wait a minute, Al, this high, part of this bull channel, is before the bear trend ended. We went to a lower low. And that's common because trends usually transition from one to another. So you have a bear trend and then a bull trend, and this is the transition period. And very often, the first high in the bull trend comes before the final low in the bear trend. That's just part of the transition from bear to bull. Wedge bull flag does not look perfect, but traders bought the reversal up from the line. The market came back down and tested the top of the channel and reversed up again. So traders are paying attention to this as a wedge bull flag. Bull breakout, pull back to about 50%, 3 pushes down, 1, 2, 3, and then a reversal up. Nested wedge bottom, 1, 2, and then you see what happens at the line when the market gets near it again. Micro double bottom, bull bar closing on its high. Good looking wedge bottom. Expect at least 2 legs up, 1 pullback, and then 2. It's nested because in the third leg, there's a smaller wedge. 1, 2, 3. Higher probability that you get a reversal up. 3 pushes down. 1, 2, 3. But there's a problem with this wedge, and that is the channel is very, very tight. The pullbacks are small. A tight channel like this, usually a minor reversal, and the rally becomes part of a trading range or a bear flag. Good looking rally, but did not get very far, and it became a bear flag followed by lower prices. The market is always paying attention to prior highs and lows, and the result is you get a lot of double tops and double bottoms. If the market rallies near a prior high and reverses down, it creates a double top. Most double tops, most double bottoms are not exact. The second high is usually a little bit above or a little bit below. Sometimes it's a lot above or a lot below. Double top, the market got near that high and reversed down again. A bear bar, signal bar, so you sell below its low. A bear bar reversing down, sell below its low. We have a high here and the market got near it and reversed down. This is a double top even though this high is below that high. Here's the signal bar. You could sell below this bar and get filled here. You could sell below this bar, second entry, and get filled there. This is a double top. This high is above that high. You can call it a higher high major trend reversal, or you could simply call it a double top. A strong bull breakout, but look at the reversal down. A good bear bar closing on its low. This is probably a bull trap, trapping traders into believing there's going to be a successful breakout, but terrible follow through for the bulls. Bears will sell on a stop just below the low of that bar, and they'll get filled right here. Small double top bear flag. The market tried to go up here, tried to go up here. You can call this a double top bear flag. You can call this a double top bear flag. You can call this high with any of these highs a double top bear flag. To me, I would view it as this is the start of the sideways correction, and this is the end of it. So to me, the double top would be one of these two highs and that high. In any case, you're looking to sell below a bar as it reverses down. And we have a small bear body, reasonable to sell on a stop right below the low of that bar. Tight bear channel, trying to reverse up. A reversal above a tight channel usually does not get very far, and you can see we reversed down. And it tested this high, or any of these highs. So to me, this is a double top bear flag, maybe with that high and that high. I'm looking to sell a reversal down. This bar went outside down. The bar before, bear bar closing on its low, reasonable to sell on the stop below that bar, or below this bar, or below the pullback bar, and get filled right here. The market tried to rally. It failed. It tried to rally strongly again, slightly higher high, but it's basically a test of this high, maybe a test of this high. For me, this is a double top right here, these two highs, or some computers will say this high is testing that high, and the double top is here. In any case, bad follow through, bear bar closing near its low. Traders will sell on a stop right below the low of that bar and get filled right there. Another double top. You get several little pushes up for the first top, and then a couple pushes up for the second top. It's a failed head and shoulders bottom. Left shoulder, head, right shoulder. Does not matter. It's the top of a tight trading range. First attempt up is here. The second attempt up is here or here. It's a double top. Traders are going to sell below the low of this bar. And the bulls will do the opposite. They're looking for reversals up after a test of a prior low. The market sold off, tried to rally, sold off even stronger to a slightly lower low, but this is a double bottom bull flag. You're in a bull trend, you have a couple attempts to reverse down, and now the market's reversing up. Traders will buy above the high of this bar and get filled here. Bear trend, trying to resume down. The bulls bought, and they bought again. The bears tried to reverse down and failed. Double bottom, this low and that low, and micro double bottom, this low and that low, a bull bar. Traders will buy on a stop right here. Strong bull breakout, deep pullback, and then look what happened here. This sell-off might in fact simply be a pullback to test the bottom of this first breakout. And this could be a large double bottom with this low, initially with that low, and then with this low, and then with this low. When I look at this chart, I think this is a double bottom here and here, the lowest and most recent of the higher lows. Traders will buy a reversal up, taking a chance that this is maybe a higher low major trend reversal. Maybe there was a bear trend over here, very strong bull breakout, and then this is simply a pullback, a bull flag, testing the bottom of the channel. So bull breakout, so a spike, and then a pullback, and then a wedge channel. Tried to break above the wedge channel, failed. Strong bull trend and pullback, and all of this might simply be a pullback from this initial breakout. And testing the bottom of that initial pullback, then the bulls have a reasonable chance of getting a resumption up. The market reversed up here. Now it has a micro double bottom, a pair of good-looking bull bars. Traders will buy above the high of the bar here or above this high and get filled right there. Traders are looking for breakout tests all the time. For example, in a bear trend, if there's a breakout, traders will watch to see what happens if there's a rally back to the breakout point. If the trend resumes down, traders will sell. It's a breakout test. Here we have a pretty tight trading range and a pretty good bear breakout. The market is trying to create a failed breakout and a resumption up. Instead, it failed to get very far and the market's reversing down again. Traders are looking to sell below the low of the prior bar and they get filled here. Part of the reason why we get this pullback? Well, you get some profit taking. The bears who shorted for any reason up here or right on the breakout will take partial profits once the market goes far enough down for them to get a scalp. So you have some bears buying. And then you have scale-in bulls betting the trading range would continue, and they had a limit order to buy at the bottom of the range. And then they see this and they say, uh-oh, I'm in trouble. However, they expect a test back up. They expect some profit taking from the bears. So those bulls will scale in, buy more, lower, maybe the size of a scalp, maybe 2 or 3 times the size of a scalp. And then they'll look to get out either at the original breakout point or a little bit below. They get filled here to buy. And if they buy more here, the pullback was more than above the midpoint of their 2 entries. They were able to avoid a loss by scaling in. They buy here, buy more here. Their average entry price is here. This allowed them to get out. But that second buying helped create the pullback that tested the breakout point. Both bulls and bears will sell after a strong breakout. The bulls will sell to give up, and the bears who did not sell originally are looking to sell as well, and the result is a second leg down after a strong breakout. The market's in a bull trend here, eventually broke below a major higher low. Major because a very strong bull breakout to a new high. So this is a very important price. As long as the market stays above it, traders will assume the bull trend is still in effect. Once the market falls below it, traders will conclude the market's no longer in a bull trend. It's either in a trading range or in a bear trend. The market broke below it, tried to get back above, failed. Traders will sell the reversal down. Tried to get above it again, failed again. A second test of the breakout, a second breakout test. A bear bar, they'll sell below that bear bar and get filled here on the reversal down. The bulls do the same thing. They're looking for pullbacks to breakout points, and then they buy reversals up. You can see a very strong breakout. Breakout of what? Well, above this high, above that high, above these highs. They're all breakouts. Here, the market tried to reverse back down to the lowest breakout point, and it failed. The bulls resumed. We reversed up from a test of the breakout point. Bulls will buy above that bull bar and get filled here. A breakout, another stronger breakout, a pullback. Look to the left to see if it's testing something. It is. It's testing the top of this range. Bulls will buy a reversal up, either above that bear bar. Usually better to buy above a bull bar. So you could buy above this bar and get filled here, or you could say it's a high 2 bull flag. Tried to go up here, tried to go up here. In this particular case, it's reasonable to buy above a bear bar. Micro double bottom, down, up, and then this bar went down, up. 2 attempts to go down, both failing in a bull trend. Traders will buy on a stop above the high of the prior bar and get filled here. Same thing, trying to reverse down, look to the left. Is it testing something? It is. It's testing this high. Trying to reverse down again, look to the left. Is it testing a prior high? Yes, it's testing this prior high. So this is simply a breakout test. This is simply a breakout test of the breakout point here. Bulls will buy a reversal up, especially above a bull bar. Get filled here and get filled here. Another breakout and then a pullback. Look to the left. Is it testing something? It looks like it's testing here. Bulls will buy a reversal up. This breakout test failed, and you can see we got a breakout here. This is bulls giving up. We have a wedge top, a bull breakout above the wedge top, and then a second reversal. So we tried to top out here. The top failed, and now we're trying to top out again a second time. So you have to be thinking that this might be a significant top. Maybe we'll test the bottom of the buy climax. The bulls who bought here will be pretty quick to get out, like below a micro double top or a double top here, looking for at least a second leg down. Bulls will be quick to get out. You can call it a triangle, 3 pushes up here, and then bear bar, and then another bull bar, second push up, bear bar, and then another bull bar, so third push up. I began by talking about what support and resistance was best, and it depends on context. On any particular chart, any type of support or resistance can be very important. Forex support and resistance is not as precise as it is with the E-mini because every broker has its own charts based upon the trades that are taking place with that broker, and other brokers have different banks and prices that are slightly different. Nobody sees all the prices from all the trades, and therefore the charts from the different brokers are slightly different, making support and resistance a little bit less precise. I then gave several examples of support and resistance. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on support and resistance. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on support and resistance. I talked about support and resistance in the prior videos. I'm going to begin by giving other examples of support and resistance. In particular, I'm going to be talking about round numbers. For example, Dow 20,000 is an important magnet. I'm then going to give a list of what I think are important sources of support and resistance. On the left, I have a monthly chart, and on the right, I have a 5-minute chart of the last day of the month. It turns out this was also the last day of the year. At the end of a month, the market often pays attention to monthly support and resistance. At the end of the week, the appearance of the weekly chart is being determined, and the market will pay attention to support and resistance on the weekly chart, especially in the final hour of the day. Monthly chart, the close of the month, the high of the month are important. This is the current month. Traders will look at the open of the month, which is right here. They'll look at the close of the prior month, the high of the prior month, the high of this month, the low of this month, the low of last month, the open of last month. And in the final minutes of the month, traders will pay attention to all support and resistance on the monthly chart. The most nearby support and resistance at the end of this month, the final minutes of the month, are going to be the open of the current month, the close of the last month, the high of the last month. Pink line, this was the high of the last month. You can see we went above it and we pulled back. We're above it and we're pulling back. So at the end of the day on this 5-minute chart, some traders will look at the monthly chart to see if there is support and resistance, and they'll watch how the 5-minute chart reacts to the monthly support and resistance. Here's the close of last month, that blue line right there. Here's the open of this month. Again, this is on the monthly chart what's taking place here. And at the end of the month, I tend to take a look at the monthly chart to see if any monthly support or resistance might be affecting the appearance of the trading today on the 5-minute chart. I'm aware of the high of last month. You can see the market's trying to hold above it, and then it broke below it. It broke below it, and tested the close of last month and bounced. And then this is a test of the high of last month. I'm going to look to buy a reversal up here. Did not get far. We're in a bear trend, bear bar. I'm going to be selling a reversal down here, betting that the high of last month is now resistance. And you can see when it got down to the open of this month, there were buyers. The bulls wanted this month to have a bull bar, even a tiny bull body, so they bought. The bears wanted this month to have a bear body, and they were selling, but it looks like the bulls are winning. At the end of the month, you can see this is the close of the day, and it's also the close of the month. It's slightly above the open of the month, and therefore, even though it looks like a perfect doji on the monthly chart, in fact, it has a small bull body. Again, traders paying attention to support and resistance on the monthly chart when they're trading on the 5-minute chart. The high of last month, possible support, the market broke below it, so you have to assume it's now resistance. If you get a rally near it, traders will sell a reversal down. Tested the close of last month, tried to get a double bottom, very tight bear channel, probably a minor reversal, which means the reversal will either be a bear flag or a trading range. Traders will look to sell a reversal down. End of the day, you can see profit taking right around the open of this month, the current month. This is the euro versus the dollar. Here's the monthly chart on the left, and here's the 5-minute chart on the right. This is the final day of the month. When I'm trading the final day of the month, I usually take a look at the monthly chart to see if there's any nearby support or resistance on the monthly chart, because it'll affect trading on the 5-minute chart. This is the current month, and this is the final day of that current month. And all through here, the market looks like it's hovering around a certain price. You look to the left on the monthly chart, it's hovering around last month's low. The market's trying to get support at last month's low. And then you start to see this, and you have to conclude the market is not going to hold the support of last month's low, and it's going to fall below last month's low. You have a sell to close finish. On the last day of the month, last month's low was support for many hours during the day. The market kept trying to reverse up, but ultimately it failed. A series of bear bars, these two bear bars closing on their lows, bulls giving up. Head and shoulders bottom, left shoulder, head, right shoulder, or left shoulder, and then head, double bottom, and then right shoulder. It fell below this higher low, a major higher low, sold off, fell below this and sold off, fell below the bottom of the head and shoulders bottom and sold off. Different computers are using different lows as the signal to get out of longs and to get short. All three are important, and you can see the market just collapsed and gave up its attempt to try to hold above last month's low. And this month closed below last month's low. This is the close of the month. It's below last month's low. This is the New Zealand dollar versus the US dollar, and it's a weekly chart. Trading ranges are support and resistance. The market broke below a trading range and tried to get back above, tried to get back above, tried to get back above. It was support. Bulls bought at that price level here, broke below, now it's resistance. After a breakout, this was support, support, support. We get a breakout, it's now resistance. Traders will sell a rally back up to the bottom of the trading range, betting that it is now resistance. Pretty good breakout above the top of this small trading range. You have to assume the top of the trading range now is support. Traders will look to buy at support at the top of the range or on a reversal up. Here's a bear trend. Traders are looking to sell at resistance. There are many ways to look at resistance here. An obvious one is the moving average, the average price. This is a 20-bar exponential moving average. Once you start to see a bear trend, traders are going to be looking to sell anytime the market gets back to the average price, betting that the average price is too expensive, and the market will then get a new low. Trying to get above the average price, pair of bear bars, sell below either that bear bar or this bear bar, get filled here. A 3-push rally, 1, 2, 3 to the moving average. Traders will sell below a bear bar here or here. We have a double top this high, that high, at the moving average, reversal down. 2 legs up, 1, pullback 2, maybe a wedge, 1, 2, 3, wedge bear flag, sell below a bear bar, closing on its low, get filled here. Double top, bear bar, sell below the bear bar. Sell below the pullback from the breakout. This is the breakout of the double top. We have a pullback attempt, sell below that. Another test of the moving average, low 2, low 1, low 2. You can call it a double top and a breakout above a double top, and that's a type of a wedge. 3 pushes up, 1, 2, 3. Anytime you have a double top and then a breakout above the double top, you have 3 pushes, 1, 2, 3. It's a type of wedge. The failed breakout above the double top is therefore a wedge bear flag. It's at the moving average, sell the reversal down. This is also a gap bar, the first bar with a low above the moving average. And when you're in a bear trend, the first time the market does anything, you have to assume it'll fail. The bulls finally get a bar above the moving average, you have to assume the reversal will fail and the market will fall. Here, first time to touch the moving average in about 20 bars, bears will sell. Round numbers are also important. They can be support and resistance. Here's a bear trend. And here are some round numbers, multiples of 10 in the E-mini. Traders will look at that as minor support or resistance in a bear trend. There was support here, it became resistance here. Traders often put stops or profit targets at or slightly beyond round numbers, and therefore trading is taking place and it creates support and resistance. Also, you have the issue of option strike prices. The price of the E-mini is about 10 times as great as the Spider. E-mini of 2110 is close to Spider 211, and 211 is an option strike price. 212, 213, 210, all option strike prices. Institutions sell options. They want options to expire worthless, so they pay a lot of attention to option strike prices. The institutions that sell, for example, 211 Spider put or call, they want it to expire worthless, so if at the end of the month the Spider is near 211, the institutions will try to get it to close as close to 211 as possible so that as many options will expire worthless as possible. And 211 approximately equals the E-mini 2110, and therefore 2110 is an important price. This is a big round number, 2100. To me, this is a small round number. That's a multiple of 100, and this is a step that's only 10 points. This is more of a minor round number, but it's still important. The strike prices are magnets. If they can get the Spider to expire exactly at certain strike prices, they have a better chance of having the options, the puts and calls at that strike, expire worthless. So the institutions will be placing trades in every market, futures, stocks, anything they possibly can trade in to help options expire worthless at the end of option expiration. The market's rallying and you're wondering, where do I put my initial stop? Maybe just a little bit below 2090. The market is bouncing here. Where should I sell? Well, maybe at the moving average. Maybe I'll place a limit order to sell at the round number, 2090. When you're trading, a lot of times you have to make quick decisions and you're not sure where to place stops, where to take profits. And a quick, easy way to do it is just grab a round number. And because a lot of traders do that, round numbers are important and therefore they are magnets and therefore support and resistance. Apple, monthly chart. In the stock market, if a stock gets near 100, it becomes an extremely important big round number. Once a stock rallies to around 90, it's usually going to get to 100. Traders know that, and the bulls buy, and bears don't want to sell because they believe it's going to get to 100 as well. So they wait to sell at 100, and you often get up to 100 quickly. Here the market's at 92, and a pullback. Traders buy, assuming it's going to get to 100. And it got slightly above 100 and then sold off. Why would it sell off? Because the bulls who bought here bet it was going to get to 100 and they're taking profits there. And the bears assumed that 100 would be resistance, and they're looking to sell at 100 or slightly above. And the result was you get a reversal. Here we broke relentlessly above 100. Traders are going to buy back at 100. It was resistance, now it's going to be support. Traders will place limit orders to buy at 100 or slightly below. In fact, you can see this high 92 became support as well. Some bears assume when the market's rallying that it's going to come back down and test support. Big round number, 100 support. So you have some bears selling up here, expecting it to test 100. And you have bulls who are taking profits up here, looking to buy on the test of 100. So they'll buy here. You can see the market raced down to 100, below 100. The bears bought back their shorts, and the bulls bought, and we got a pretty strong reversal up. Crude oil, daily chart. Strong bear trend, and the market is just above 40. If you watch television, you'll hear traders start to talk about a 30 handle. A 30 handle means a price that has 30 at the start of it. A 30 handle is anything between 30 and 39.99. When the market starts to get near 40, it usually is going to fall below 40 because traders want to see what will happen if it gets a 30 handle. Will it collapse down to 30? Will it collapse down below 30? Or will buyers come in? Part of this strong sell-off is that. It's a vacuum test of the 30 handle. And traders bought as soon as it had a 30 handle. Fell a little bit below 40, and they bought. They bought strongly. And then look what happened when it got up to a big round number, 50. It went a little bit above, and it sold. So the traders who bought at 40, a lot of them took profits around there. The bears assumed that 50 would be a big round number, resistance. They assume bulls will take profits, and the bears sell, and they get a scalp. It tested 50 again, same process. The bulls who bought this bull flag again took profits, and the bears who saw the sell-off originally at 50 sold again. And you get a double top bear flag. This is the dollar versus the Swiss franc, a 240-minute chart. It's a bull trend. Traders are going to look to buy pullbacks to the moving average. This is the average price. I have a 20-bar exponential moving average here, but any moving average works. All of them are some measure of an average price. Gets near the moving average, traders start to buy above the high of the prior bar. Near the moving average, they'll buy above the prior bar. Moving average, they'll buy above the prior bar. Moving average, bull bar, even better to buy above its high. Again, a moving average test, they buy above the high. Big round number, 0.9000. Big round number, 0.9100. Market gets vacuumed up to the big round number, and bulls take profits, bears sell for a scalp. Broke above it and pulled back to it, reversed up. So what was resistance now is support. Next big round number up here, 9100, 0.9100. Bulls take profits, bears sell. They sold again. We get a couple legs down. Daily chart of the E-mini. Many traders pay attention to simple moving averages. Popular ones are 50-day moving average, 100-day, 150-day, 200-day. I have them color-coded here. And in a bull trend, bulls will buy reversals up after the market pulls back to any of these moving averages. You can see it pull back to the pink line, the 150-day moving average, reversed up. Fell below the yellow line, the 200-day moving average, reversed up. And you can see a lot of the reversals are taking place at these lines. Pull back to the 50-day moving average, kept reversing up. Traders are looking for reversal attempts down, betting the bears will fail. 80% of reversal attempts in a bull trend will fail. One support level is a moving average, and traders look to buy a reversal up from any of the moving averages. They never know in advance which one will be the bottom, but if they see the market reversing up from the neighborhood of a line, they will look to buy. A bear trend, the euro versus the British pound. And here are a series of simple moving averages. 50-day, 100-day, 150-day, and 200-day. Anytime the market gets near a line, if it starts to reverse down, traders will look to sell the reversal down. Simple moving averages provide support and resistance. This is a daily chart of the euro versus the British pound, and big round numbers can be important as well, so multiples of 100 pips. Here, multiples of 1,000 pips. You can see the market fell and then went sideways. It was finding support at 0.8000. Ultimately, it got a bear breakout and it raced down to the next big round number, 0.7000, and bounced. Bears took profits here. Bulls bought at the big round number, betting that the bears would take profits and we would get at least a small bounce. Multiples of 100 pips, multiples of 1,000 pips, support and resistance. Traders often put stops just beyond the big round numbers, and they also take profits at the big round numbers as well. Round numbers, there are option strike prices for currency future options and Forex options. Forex options, no one that I know trades them, so they're not widely traded, but some traders do trade currency Forex options. Institutions sell the options. They want the options to expire worthless. Options expire worthless at strike prices. Institutions are always going to try to manipulate the price of the underlying, for example, a Forex market, so that when an option is expiring, it'll be around a big round number. And because the option strike prices are important, they are magnets. Here is a list of support and resistance. Trend lines, obviously, prior highs, prior lows, measured move targets, moving averages on any time frame, plus any type of the major moving averages. For example, on a 5-minute chart, I use a 20-bar exponential moving average. On a daily chart, I use simple moving averages, 50, 100, 150, and 200-bar moving averages. In a bull trend, the low of the entry bar is support. In a bear trend, the high of the sell entry bar is resistance. The buy signal bar high, the bear signal bar low. Entry prices, scale-in traders exit at prior entry prices, so that's support or resistance. The highest and lowest close of any swing. Profit targets where scalpers would be taking profits, that creates support and resistance. For example, if you're buying in a bull trend and you're scalping, you're going to be selling at a scalp distance above, and that means the market will tend to turn down there, and therefore it's resistance. The high, the low, the open, and the close from today or yesterday. And on daily, weekly, and monthly charts, toward the end of the day, toward the end of the week, toward the end of the month, support and resistance on those time frames becomes important. Intraday on a 5-minute chart. For example, in the last hour of the month, if you're trading on a 5-minute chart, you sometimes can find some trades based upon support or resistance on the monthly chart. Daily pivots, I never use those. Big round numbers, like Dow 20,000. Fibonacci retracement levels and projections. I think most traders don't pay much attention to those, and I think they're not helpful. However, 50% pullbacks and 100% measured moves are extremely important, and you'll see them every day. And then any type of band, which I do not use. In this video, I talked about many other types of support and resistance. In particular, I talked about round numbers and how they can be very helpful. For example, in stocks and commodities, option strike prices are often at round numbers. And because institutions sell the puts and calls and want the puts and calls to expire worthless, they try to have the underlying contracts at the strike prices when the options contracts expire. And since the strike prices are often round numbers, those round numbers are magnets, especially on option expiration days. I then gave a more complete list of things that often provide support and resistance. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on support and resistance. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on support and resistance. I'll begin by talking about how the closes in a buy the close bull trend often are resistance, and how the closes in sell the close bear trends often are support. I'll then talk about breakout tests. The market often breaks out and comes back to test the breakout point, and that breakout point, therefore, is a magnet. And in a bull trend, it's support. In a bear trend, it's resistance. Strong bull trend, microchannel beginning here, bull bar, bull bar, bull bar. At some point, you have to decide the market's going higher, and you begin to buy closes. For example, you buy this close, any of these closes, no bear bars, even the first bear bar, you'll buy that close. In strong bull trends, I call it a buy the close bull trend because strong bulls are buying as soon as the bar closes. They're betting that the market is going to go higher, even if there's a pullback first. 3 consecutive bull bars, traders will buy the close, buy the close, buy the close. They'll also buy the first bear close. They'll also buy below bars. They'll also buy above bars. But I'm talking specifically here about buy the close. At some point, you get a break below the bull trend line. And some trader bought this close or that close. So they bought the highest close in a bull trend. And that is important. The first reversal down in a strong bull trend, probably minor. The market then is either in a trading range or a bull flag, not a bear trend. So traders buying this close are confident the market will get back here at some point, and many will look to buy more lower down, like above a bull bar, betting that the market will come back to that close. Bulls disappointed by this, the size of this sell-off. They conclude it's no longer a strong bull trend. They add to their position, they scale in. They think it's probably a trading range or a bull flag. Trading range, you want to buy low, like above a bull bar on a reversal up. The bulls who bought here bought believing it was a strong bull trend, but confident the first reversal down would be minor and that the market would test back up again. After they see this, they conclude the bull trend is over and it's now in a trading range. And if it's in a trading range, they're going to trade it like a trading range. They want to buy low and they want to sell high. Many of these bulls who bought this close and bought more here want the market to come back to their original entry price, and then they'll sell. They'll sell out and get out break even on their first buy and with a profit on their second buy. They're buying low, they're selling high to sell out of their longs to take profits, and they're taking a small profit, so they're scalping. They believe the market's probably in a trading range. Because these bulls who bought this close and added on here are trying to sell here, you have bulls selling. That increases the chances that the market will reverse down. It also obviously increases the chances that the market will not continue up. The high close, therefore, is resistance. Strong sell-off, no longer a strong bull trend. Once it gets back up here, these bulls will be made whole again. The ones who scaled in will make a profit. The ones who did not scale in will conclude the market is no longer a strong bull trend. They'll stop trading it like a strong bull trend, and they'll exit out of their longs, break even on their original entry. Because you have bulls selling there, and you always have bears selling for any reason, chances are the market will try to turn down there, or at least stop going up. And therefore, it's resistance. It took a lot of bars to get there, but what happened once the market got back to that prior high close? The bulls sold. The bulls who bought here sold, getting out break even. The bulls who bought here sold to get a scalping profit, betting that it's a trading range. They want to buy low, they want to sell high, and they want to scalp. The bears want to sell here as well because they know the bulls are disappointed by what took place, and therefore the bulls will be taking profits up there or selling up there, and the bears sell up there as well. Bulls have limit orders to sell the high close. They'll get out either on a limit order at the high close or on a reversal down, especially below a bear bar. So they'd get out here, maybe with a small loss. Whenever the bulls sell, it creates resistance. The bears want to sell at resistance. The bears sell there as well. They'll sell at the high close, and they'll sell on the reversal down. Strong bear trend. A lot of bears, as soon as they see a bear bar, they'll sell. Look at the close of this bar and look at the open of this bar. This open is below that close. That tells you that as soon as this bar closed, a lot of bears hit the button to sell the close, and the next bar opens slightly below. The same here. So that tells you that bears are very eager to sell. As soon as the bar closes, they're hitting the button on their computer to sell at the market, and the next tick is below the close of that bar. It's a sell the close bear trend. Bears are selling closes, and a lot of bears will keep doing it until they believe it's no longer a sell the close bear trend. High probability that the market will go lower, at least lower enough to make a profit, a small profit. At some point, you're going to get a reversal. At some point, you'll have enough bears taking profits, and the market will start to go up. Remember, these bears now have stops way up here. The bears who sold up here, the market's down here now, their stops are way up here. Their risk is big. The best way to reduce the risk is by taking some profits. And if you have enough profit taking, you can get a series of bull bars, enough to make the sell the close bears believe it's no longer a sell the close bear trend. This rally then is either a bear flag leading to another leg down or the start of a trading range. Good buying pressure, 3 bull bars closing on their highs, a 4th bar closing above its midpoint. The bears assume that their sell the close bear trend has ended and the market's either converting into a trading range or a bear flag. In either case, they're not expecting a lot lower prices for the time being. Many bears will add to their position as the bear trend resumes because a lot of them think that this is disappointing, sufficiently disappointing so that the market probably will enter a trading range. Big down, big up, big confusion, sideways. They expect that sideways means if it gets back down to this low, there'll be buyers, and there will be. Some of those buyers will be the bears who sold here, happy to get out break even. Other buyers will be bears who sold here and sold more higher, looking to get out break even on their first entry and with a profit on their second entry. And other buyers here will be bulls knowing that the bears will buy back at the low close and expecting a bounce from the bears buying. A bear who adds on, there are different ways to do it. The bear who's adding on is looking to make a scalp. So his second entry has to be at least the size of a scalp greater than his first entry, preferably 2 to 3 times bigger than a scalp. And the market's getting near that low close. It's bouncing here. So the bears who sold here and here, or simply the bears who sold here, are concerned now that the market may not get down to that low close. If there's suddenly a very big bull bar, that would be a sign that the bears are giving up. And the bears who sold will buy back their shorts. Usually will lead to a swing up. However, this is not strong enough up for the bears to give up. They're still hopeful that the market will get down to that low close. They're trying to exit here, whether or not they added on. Some bears did not sell here. They understood what was going on. Sell the close bear trend. Disappointed bears, probably conversion into a trading range, probably a minor reversal. That means the market will probably test back down here. So some bears will just start selling up here. Again, their entry price has to be at least 1 to 2 times bigger than the minimum scalp size. They're expecting buyers to come in around the low close, and they want to be able to make a scalp, so they want to make sure that they're selling at least 1, 2, or 3 times the size of a minimum scalp above their target price. Is this enough of a reversal to conclude that the bears are giving up and buying back their shorts? Well, it's a good reversal, but it's still about a 50% pullback, and it's 2 legs up, 1 pullback, 2. We have a bear bar closing on its low. Some bears will sell below this bar. You have bears who sell the low close. They sell all of the closes. They sell the low close, and then 1 or 2 or 3 times bigger than the minimum scalp, they'll sell more. Other bears take this sell, and they'll only sell more below a bear bar like this, and they'll only sell more up here if the distance between here and their original entry is at least 2 or 3 times bigger than a minimum scalp. They're hoping to make a scalp. They sell below this bar, get filled here, and then look to buy back here. And since they're selling 2 to 3 times bigger than the minimum scalp above here, when the market comes back down here, they'll make a profit that is 2 to 3 times the size of a scalp. So many bears wanted to buy here that the market could not get there. the bears started placing limit orders just a little bit above the line just in case we did not get there. Eager buyers, and the same with the bulls. Bulls doing the same thing, thinking that there'll be buyers here, strong enough rally so that probably buyers here. We have an undershoot. The market did not quite reach the line. Some bears will sell closes. They'll sell the size of a scalp or 2 to 3 times the scalp higher, and then they'll sell below a bear bar if this entry is 2 to 3 times as big as a minimum scalp above the first entry. If you take this trade, that trade, and this trade, you have to trade small enough so that your risk is no bigger than on any other trade. The stop for all of these bears, probably all the way up here, the top of the last major lower high. Market comes back here, and what happens? Support. The low close is support. The bears who sold here buy back their shorts. If they added on, they buy back their shorts for a scalp. If they did not sell here and instead sold here or here, they buy back their shorts for a profit. The bulls know the bears will buy, and the bulls buy as well, and you get a bounce. Bears taking their profits. Bears, they place limit orders to buy at the lowest close. When it gets down to that low close, they buy. And that means bears buying, bulls are always buying, the low close becomes support. Strong enough rally, probably a trading range. Traders bought the low close and they got another bounce. Eventually, once you have a trading range, there's a 50% chance of trend resumption down, 50% chance of trend reversal up. Here, the bears got trend resumption down. Remember, wherever the bears are going to be buying, the bulls are always buying, and the bulls will buy at that low close as well. Other bulls will buy on a reversal up. Also, some bears will hold, taking a chance that we get a big breakout like we have over here. They're hoping it comes here. When it does not and the market reverses up, the bears who did not exit at the low close will exit on the reversal up. Whenever there's a logical, reasonable buy signal in a trading range or in a weak bear trend, bulls will buy, and they'll buy more lower. We have a bull trend, maybe a trading range, double bottom bull flag, double bottom high or low. Bulls will buy that reversal up, believing that this is not strong enough to convert the bull trend into a bear trend. However, it might be enough to convert it into a trading range. They'll buy here, taking a chance that we get a double bottom and a rally, knowing that it may go lower, but probably not form a bear trend. So some bulls will buy here, use a very wide stop, and then buy more above a bull bar on a reversal up. What will happen when the market gets back to their original entry price? They'll make a profit on this entry. They'll be happy to get out break even on their original entry. That means the original entry price is resistance because you have bulls selling at that price. Bulls selling at a price makes that price resistance. I'm now going to talk a little bit about a breakout test. We have a breakout, and then the market pulls back to the breakout level. The market's reversing up, good-looking buy signal bar. The market's reversing up, good-looking buy signal bar. Good-looking entry bar, good-looking entry bar. After buying, the market often tests back down to the original entry price to see if bulls will again buy at that price. Here, it dipped below the price. It dipped below the price again here. And again, bulls bought at the original entry price. The market reversed up strongly, a lower low, major trend reversal, wedge bottom, 1, 2, 3, micro double bottom, good looking buy signal bar. The market tested the price here, the bulls bought again. The market came back down to test that price again. The bulls bought again. Both of these are undershoots. The market did not fall all the way down to the entry price. However, this entry price is support. This entry price is support. Here, it overshot the price. It fell below the entry price. And here it undershot it. It did not quite reach the top of the buy signal bar. I said entry price, I meant the top of the buy signal bar. The entry price is just a little bit above. After a strong reversal, a convincing reversal, a lot of bulls might scalp out part of their longs for a profit and then place a limit order to buy again at either the signal bar high or their original entry price just above that high. And if enough bulls are buying, the market will go up again. And the same is true here. Bulls bought above the entry price. They were so eager to buy, many bulls started placing limit orders just above that price, just in case it does not fall all the way down to the signal bar high. It's a sign of eager bulls, and they did it again here. Double bottom, higher low. Although it did not go up very far, the bulls did buy again above the original signal bar high. Other bulls buy on a reversal up. You have a breakout and then a pullback testing the breakout level, and they'll buy on a reversal up there or above this bar or above a bull bar here. Whenever there's a logical sell signal in a bear trend, a weak bear trend, or a trading range, bears will sell. For example, here we have a bull trend, maybe a wedge, 1, 2, 3. One leg down, maybe a double top, lower high. Maybe we'll get down to this higher low or that higher low. Decent bear bar. Some bears will sell here, betting that if we break out to the upside, this is the start of a trading range. The trading range will simply be higher, and they can sell more higher, expecting the market to come back to their original entry price. If the premise of a trading range is still valid, and it probably is, we have a bull breakout with bad follow-through, bull bar, bad follow-through, probably this whole thing is a trading range. Some bears will sell more. For example, below a bull bar on the reversal down, micro double top, 1, 2, higher high, major trend reversal, bull trend, bear breakout, higher high. And the bulls who took this original sell will place a limit order to get out break even at their original entry price or at the sell signal bar low. The bears who sold here will exit there as well, expecting disappointed bears to buy back their shorts at this level. If bears are buying here, chances are there'll be a bounce. The bears selling here will buy here as well. So the signal bar low, the original entry price just below that low, becomes support. Support is always a magnet, and the market tends to get drawn down to it, which it did over here. A lot of trading range price action. Leg 1, pullback, leg 2, failed breakout, low 2, and possibly a trading range or a weak bull trend. So some bears will sell just below the low of this bar, and they'll get filled here. Market often rallies back to test that entry price. You have some traders who bought that low, arguing maybe the start of a strong bull trend. They use very wide stops, and once they start to see this, they're hoping the market will come back here for these bulls to exit break even. As the market's going down, the bulls are more and more disappointed, and they're very hopeful that it'll get here so they can get out break even. So as it's going down, you have bulls hoping to be able to sell out of their longs. You have bulls hoping to sell there. So bull selling creates resistance. And you have bears who sold here and made a profit. When it gets back there again, they're going to say, the last time I sold here, I made money. It's back here again. I'm going to sell again. So you have bulls and bears selling at the signal bar low and the entry price low just below the signal bar low. Selling where scale in bulls exit. Bulls bought here, they bought more lower, and they're happy to get out break even. Other bulls bought below this bar and used a very wide stop, bought more, maybe above this bull bar, and happy to get out break even on their first entry and with a profit on their second entry. And the result is the bottom of that bar becomes resistance, an area where bulls will sell and bears will sell as well. The bulls who did not get out here were hoping for a resumption of the bull trend. Once they see the reversal down, if they did not exit here, they'll exit on the reversal down and get filled here. We have a bull trend line trading range, possibly lower high major trend reversal, and we have a bear break below the trend line, bears will sell below a pullback. So we have a bear breakout below the trend line and a small pullback. Bears will sell below the low of that pullback bar and get filled here, just below the low of that bar. You have bulls buying below that bar as well, betting that the reversal will fail and that we'll be in a bull trend that continues higher. The bulls who did buy here will buy more lower, and they'll hope to get out break even. The bears who sold here made a profit, and if it gets back to that price, they'll say, I made money the last time I sold at that price level. If it gets back to that price level again, I'll sell again. And therefore, you'll have both bulls and bears selling here, and this becomes resistance. A reasonable entry price for the bears becomes resistance. Scale and bulls who bought here, bought more lower, maybe above this bar. They'll be exiting there, so you have bulls selling. The bulls who did not sell with a limit order have to sell on a reversal down in case this is the start of a bear trend. They'll exit below the low of the prior bar after the market gets back to the target. Reversal up, bulls will buy. Good looking buy entry bar, and the market dipped below the low of the entry bar, and the market reversed up again. Very often the market will dip a little bit below the entry bar and then reverse up. Some bulls will place a limit order to buy at the bottom of that bar. It's a big bull trend bar, therefore a buy climax bar. The market often falls a little bit below the bottom of the buy climax bar and then rallies again, just like it did over here. Some bulls will place a limit order to buy here. Others will buy on the reversal up, especially above a pretty good looking bull bar. We have a buy signal bar here. Some bulls will buy with a limit order at that low. Others will buy on a reversal up from a test below the original buy signal bar. The bottom of an entry bar, the bottom of a signal bar. Both are support. Two legs up, 1, 2, decent bear bar, strong entry bar. This is the sell signal bar, this is the sell entry bar. It's a big bear trend bar, and therefore a sell climax bar, and the high of a sell climax bar is always a magnet. Some bears theoretically have their protective stops just above that bar, and weak bears will get out there, strong bears will sell there. Therefore, strong bear selling means that the high of that entry bar is resistance. Bears will be selling up there, or they'll sell on a reversal down, especially below a bear bar. Breaking above the top of the sell entry bar, traders will sell either at that price or on a reversal down. In this video, I began by talking about how the closes in a buy the close bull trend can be resistance, and how the closes in a sell the close bear trend can be support. Also, whenever the market breaks out and comes back to test the breakout point, that can be support in a bull trend and resistance in a bear trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on support and resistance. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on support and resistance. The highest close of the day often is resistance, and the lowest close of the day often is support, in part because a lot of institutional traders use line charts, and they don't see the high of the day or the low of the day. They only see the highest and lowest closes of the day. Bull trends need higher lows, so the prior higher low in a bull trend is support. Bear trends need lower highs, so the prior lower high in a bear trend is resistance. I'll also talk a little bit about 50% pullbacks. I think a 50% pullback is the most important of all pullbacks. Bull trend, this is the highest close at this point, and then the market sold off. You have buy the close bulls buying there, looking to buy more above a bull bar here, hoping that it gets back to that high close, where they can get out break even on their first entry and with a profit on their second. The bears try to trap bulls. The bears know there were bulls buying these closes. The bulls were disappointed, and they're now hoping to get out break even. Some bulls will place a limit order to get out at their original entry price. Some will be so disappointed by these 4 bear bars, they'll place a limit order just below that price. If enough bulls have their limit order a little bit lower, you'll get a reversal down from below that high close. And the bears know the bulls are doing that as well, and they want to trap those bulls. They want to force the bulls into giving up. The bulls gave up here, the bulls gave up here. So the bears are selling as well at and below this close, knowing that if the market does not get up to that close, the bulls who are still long will have to give up. Tried to get up there, could not. Bears will sell on the reversal down. Bulls will sell here as well, taking the loss, thinking that it tried to get to the high close, could not, we're probably going lower, and bulls eventually will give up. The high close, therefore, is resistance. Lowest close, support. Disappointed bears who sold this close are happy to get out break even. When they see the 2 bull bars here, failed breakout below a prior low, maybe a wedge, 1, 2, 3, and then they get this bull bar. The bears who sold here are saying, uh-oh, I'm in trouble. This may turn up. When they see this, they place a limit order to get out break even. The bulls see the same thing, and they say, I think we're going up. I'm going to try to buy a test down to this low close. They see the strong reversal up. They place a limit order to buy at that low close. The same right here. We have another decent sell-off. This is the low close. The bears who happen to sell that close see this and say, darn, look at that, I'm in trouble. And they place a limit order to get out break even, or maybe a limit order to buy a little bit above that close, just in case it does not come all the way down there. The result is this low close then becomes support. Bears and bulls are trying to buy the low close, expecting the market to go higher, and they'll buy above the reversal bar, expecting that bears will give up, which they did right here. Here, the bears were able to get out break even. The bears who sold this low close. Here, the market did not get down to their entry price, and the bears got trapped and they gave up as the market went higher. Bears sell bear closes, betting on lower prices. They see a rally, and they're hoping the first reversal up is minor. Therefore, some bears will look to sell below a bear bar, hoping that it gets back down here and they can get out break even on their first sell and with a profit on their second. The rally, I think, here is especially strong, and a lot of these bears now have given up on the hope of making a profit. They do not believe it's going to come all the way back down to the low close. However, some will scale in. And why would they scale in? Not to make a profit. They scale in to avoid a loss. They sell that close, they sell this bar or slightly below it, and then they place a limit order to get out break even at the midpoint of their 2 entry prices. And therefore, this is support as well, the midpoint of 2 reasonable entry prices. And it's a 50% pullback. I don't have it drawn in, but from this low to that high, this is about a 50% pullback. And bulls will always have limit orders to buy a 50% pullback after a strong reversal. Most traders would not take that sell. Possible trading range, not strongly down. Bear bars, bull bar, bear bar, bull bar, and then the biggest bear bar, possibly a 2-leg trap, leg 1, pullback, leg 2. So experienced traders would not take that sell. Those who did would realize their mistake after these 4 bull bars, and then they're hoping to get out simply break even and not with a profit. I'm using this slide just to illustrate the point that the low close is support. Bulls buy closes, hoping that the rally will continue. Some bulls who bought the high close, very disappointed by the 4 big bear bars. They'll buy more above a bull bar here or here, hoping to avoid a loss. However, after this much selling and the bulls look to the left and say, oh, this is a trading range, and I bought the top of a trading range, I made a mistake, I'll buy more here, not with the intention of making a profit, getting out at the original entry price, but with the intention of trying to avoid or minimize a loss. They bought this close, They bought more above a bull bar here, and they're hoping to get out break even. At the midpoint of their two entry prices, it has to get a little bit above that price, which it did here. And the bulls getting out break even on their entire trade creates resistance. It's also about a 50% pullback of the entire bear leg. So other bears will be selling there simply because it's a 50% pullback. Most traders would not buy up here. I'm just trying to illustrate a point. There are some that would buy closes, hoping for a continued bull trend. Most traders would be concerned about a double top here or a bigger double top here, trading range price action. However, some would buy here, use a wide stop, hoping that the trend would continue up, confident that if it reversed down, it would be a bear leg in a trading range, and it probably would come back up there later. Bull trends need higher lows, bear trends need lower highs, and therefore we have support and resistance. In a bull trend, the market should not fall below support, and that support becomes a magnet. The market often comes down to test it. Strong bull breakout, buy climax. The market often tests below the bottom of a buy climax, and then buyers come in. You have bears selling up here, taking profits at the bottom of the buy climax. You have bulls looking at this saying, wow, the last time the market was here, it rallied strongly. If it gets back there, maybe it'll rally strongly again. So the bottom of a very strong rally becomes support, a magnet. The market gets drawn down to it. The bottom of the entry bar, low. The bottom of the bull trend is also support. If it gets down here, probably buyers in that area as well. Bottom of the buy climax, the strong rally, the bottom of the entire bull trend. A lot of times in a trading range like this, we have a buy climax and a trend low, two support levels near one another. The market falls below one, but not below the other, and then enters a trading range. If it's a strong bull trend, it should not be falling below significant higher lows like here or like here. And if it does, then the premise of a strong bull trend is no longer valid. If it's not a strong bull trend, then maybe it's a broad bull channel or a trading range. In either case, traders will be looking to buy a reversal up from a breakout below support. Strong reversal down, so possibly a bear trend, and the market should not rally above significant highs if it's going to be a bear trend. The top of the bear trend or a bear leg in a trading range. This is the top of the bear trend. This is the top of the strong bear breakout. Both are magnets. And in a trading range, whenever there are two resistance levels near one another at the top of the range, the market often goes above one and reverses down without getting above the top of the other. In any case, if you have a potential bear trend and the market starts to go above significant major lower highs here or here, the premise of a bear trend is no longer valid. It could still be a broad bear channel, but it's probably now a trading range, possibly even a bull trend. But the idea of a strong bear trend is no longer reasonable. It's resistance. Traders will sell either with a limit order there or on a reversal down, especially below a good-looking bear bar. 50% pullback, probably one of the most reliable sources of support and resistance. By the way, I want to make the point that Fibonacci traders often talk about a 50% pullback. 50% pullback is not a Fibonacci number, but the Fibonacci traders treat it like a Fibonacci number. It has nothing to do with Fibonacci. However, it's the single most important pullback retracement level, much more important than any Fibonacci number. Strong rally, 50% pullback. In a strong rally like this, if it starts to reverse down, bulls will place limit orders to buy a 50% pullback, betting that the bear reversal attempt will fail and that the bull trend will resume. They either buy with a limit order at a 50% pullback or on the reversal up. using a stop order. The bull trend continues only if it continues to form major higher lows. A strong rally to a new high, this now becomes a major higher low. As long as the market stays above this low, it's a bull trend. Strong breakout to a new high, this now is a major higher low. This is a minor higher low. One bull bar, not a strong breakout. This is minor, so the market can fall below it and still be in a strong bull trend. Another strong reversal up. Bulls will place limit orders to buy a 50% pullback or above the high of the reversal bar or above the high of this bull bar, betting that the bull trend is resuming. Very common for the market to dip just a little bit below 50%, to test below it. And because it often dips just below 50%, traders with limit orders at 50% usually get filled. If it does not dip below 50%, a lot of these bulls who wanted to buy at 50% are not filled. Instead, they'll buy on a reversal up, especially above a bull bar, using a stop order. 50% pullback in a bear trend is resistance. Here's a bear trend. This is 50%. Bears will sell a 50% rally. They'll place a limit order to sell using a stop above the top of the bear trend. If they do not get filled, they'll sell on a reversal down. Here we went above 50%. They'll sell on a reversal down. Some bears will say, well, wait a minute. These are two good bull bars. I'll wait for a second entry sell. And then they'll take it here. It's also a wedge. 1, 2, 3. Some bears sell with stop orders on reversals down. Others sell with limit orders. Stop above the top of the most recent lower high, which in this case is the top of the bear trend. It continues to be a bear trend only if it continues to form major lower highs. The bears sell pullbacks to prevent the market from going above a major lower high. Is this a major lower high? No, it's minor. It did not lead to a strong sell-off to a new low, and therefore going above it could simply still be part of a bear flag or a bull leg in a trading range. Going above this high does not end the bear trend. The sell signal bar, the sell entry bar. The top of the signal bar is resistance. The top of the entry bar is resistance. Weak bears put their stops just above either bar. Stronger bears will use wider stops, just in case it evolves into a trading range and this is not quite the top of the range. Not a great sell, probably minor reversal. Very tight bull channel. Usually the first reversal down is minor and you get a trading range. Here we got an endless pullback in a bear trend. The bears are creating signs of strength because every pullback stays below resistance. Another pullback, lower high. Try to reverse up, could not trigger the buy. Early signs of maybe a small pullback bear trend, which it was. Some bulls bought this as a small bull flag, disappointed by this, hoping that it gets one tick above this signal bar high so they can get up, break even. Traders know that the bottom of the sell signal bar and the top of the sell entry bar are resistance. And if the market gets there, bulls will resume. The market tried to get above there here, could not. Tried to get above there here, could not. So now we have a double top lower high, and you can see the bulls gave up here. It's a sign of strength on the part of the bears. You have bulls who bought for whatever reason, assuming the market would get above the entry bar high, and it failed. So the bulls are trapped here, they're trapped again here, and they gave up here, and they gave up here. Double top bear flag with these two highs. The biggest bear bar occurring 20 or more bars into a bear trend, more likely an exhaustion gap between this low and any of these lows, gap between this low and the low of the bar before the sell climax bar. Chances are the market's going to close the gap, get above this low. Chances are it's going to go at least a little bit above the top of the sell climax bar. The top of a sell climax bar late in a bear trend is a magnet. It's resistance. Everyone knows the market's probably going to get there. This is more likely an exhaustive end of a bear trend than a measuring gap, the start of a new leg down. The biggest bear bar, 20 more bars into a bear trend, probably an exhaustive end of a trend, and therefore the top of the bar is a magnet. The top of the entire strong sell-off is a magnet as well. This is the last major lower high. Strong breakout to a new low, so it's a major lower high. And the bears are in a bear trend as long as it keeps forming major lower highs. If it gets above a major lower high, the premise of a bear trend is no longer valid. The market's either in a trading range or in a bull trend. Weak bears see a strong bear bar like this. They don't want to risk much. They'll put a stop just above the top of the sell climax bar instead of the top of the most recent major lower high. Strong bears know that the market is probably going to go above here, and they're buying back their shorts down here. And bulls know that this is probably an exhaustion bar, and they'll either buy the close or they'll buy the reversal up or they'll buy a double bottom, expecting the market to go at least a little bit above this bar. Strong bears know the weak bears will give up, but they also know that the bulls will take profits at the top of the sell climax bar, so strong bears will sell for a scalp. Whenever you get a sell climax late in a bear trend, usually the market's going to go at least a little bit above the high of that sell climax bar. And we have an attempt at a double top, the top of the sell climax and here. And we're getting a bull breakout above the double top. You have to be looking for a measured move up as the minimum target if it starts to go up. Maybe a measured move up based upon the height of the entire bear leg from here to here. And it looks like more computers use that for their measured move projection. And you can see a lot of profit taking right around that target based upon the height of the entire final bear leg. Major lower high, strong breakout to a new low. Once the market gets above it, the premise of a bear trend is no longer valid. It's now either a trading range or a bull trend. On the left here, a pair of good-looking bull bars, but it could be an exhaustive end of the bull trend, and the bottom of the buy climax is support. Weak bulls will put their stops here, and they'll get stopped out. Strong bulls will buy here, at least for a scalp. And bears who sell up here will be taking profits down there, so the bears will be buying here as well. Since we cannot see the bars to the left, we don't know if this is late in a bull trend, but let's assume that it is. The bottom of a buy climax late in a bull trend is support. It's a magnet. The market usually gets drawn to it, and usually the market dips at least a little bit below. Usually you get some kind of a bounce, and then the market decides whether it'll form a double bottom, break above the neckline, and rally for a measured move, or a failed double bottom, break to the downside for at least a measured move. Weak bulls put their stops here instead of below a major higher low. Strong bulls assume they'll be able to make a profit by buying at that low, at least for a scalp. Once the market falls below the bottom of the buy climax, you have big up, big down, big confusion, probably a trading range. In any case, the bull trend is probably over, at least for the time being. Again, we have an attempt at a double bottom. Instead, get the bear breakout. We got a measured move down, and you can see once it fell to the measured move, there was some buying. Bears who sold for any reason are taking partial profits here. The bulls know the bears will buy here, and you'll have bulls buying here as well, at least for a scalp. I began by talking about how the highest close of the day often is resistance, and how the lowest close of the day often is support, and therefore they are magnets. Bull trends need higher lows. The bears are always trying to get the market to fall below the most recent major higher low, and therefore higher lows are support. Bear trends need lower highs. Bulls are always trying to break above the most recent major lower high, and therefore lower highs are resistance in a bear trend. 50% pullbacks, very important in all trends. Traders are always looking to buy a 50% pullback in a bull trend, and therefore it is support. And bears are always trying to sell 50% pullbacks in bear trends, and therefore a 50% pullback in a bear trend is resistance. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on support and resistance.